Have you ever wondered how businesses are valued in the long term? Well, it's not as simple as looking at a company's current profits or assets. One of the key tools used by financial analysts to estimate a business's value is called terminal value. So, what exactly is terminal value? Essentially, it's the value of an asset, business, or project beyond a forecasted period when future cash flows can be estimated. It's based on the assumption that a business will continue to grow at a set rate indefinitely, beyond the forecast period. It's worth noting that terminal value often comprises a hefty portion of the total assessed value. Forecasting the future is never easy, and this becomes even more challenging as the time horizon grows longer. This is particularly true when estimating a company's future cash flows. However, businesses need to be valued, and this is where financial models like discounted cash flow come into play, coupled with certain assumptions to derive the total value of a business or project. Discounted cash flow is a popular method used in feasibility studies, corporate acquisitions, and stock market valuation. The theory underpinning this method is that an asset's value equals all future cash flows derived from that asset, discounted to their present value at a discount rate, representing the cost of capital, such as the interest rate. This method has two major components: the forecast period and the terminal value. Typically, analysts use a forecast period of about 3 to 5 years, as anything longer tends to reduce the accuracy of the projections. To calculate terminal value, two common methods are used: the perpetual growth model and the exit multiple. The perpetual growth model assumes that a company will continue to generate cash flows at a constant rate forever. On the other hand, the exit multiple approach assumes that a business will be sold for a multiple of some market metric. Terminal value can be estimated using various formulas, most of which project future cash flows to determine the present value of a future asset. The liquidation value model, or exit method, involves determining the asset's earning power with an appropriate discount rate and then adjusting for the estimated value of outstanding debt. In contrast, the perpetuity growth model doesn't assume the company will be liquidated after the terminal year. Instead, it assumes that cash flows are reinvested and that the firm can grow at a constant rate indefinitely. The multiples approach uses the approximate sales revenues of a company during the last year of a discounted cash flow model, then applies a multiple of that figure to arrive at the terminal value. In conclusion, terminal value is a critical tool in financial analysis, offering a way to estimate the long-term value of a business or project. It's not a crystal ball, but it's a crucial part of the toolkit for anyone seeking to understand the potential value of a business in the long run. Whether you're a business owner, a potential investor, or just curious about finance, understanding terminal value can provide valuable insights into the world of business valuation.